Hey everybody, welcome to SRT Live. I am your host, Sean Richard with the Sean Richard Mortgage Team. Has the market lost confidence in the Fed's ability to control inflation? We're going to get into that today and cover some of our normal data points for the housing market and the economy. Let's start with last week. Last week, a little bit slower week, so we can get through it pretty quickly. Last week, we got, as usual, our jobless claims. And if you're watching for the first time, this is the unemployment claims. So this is broken up into two parts. This is the initial claims, individuals filing for unemployment for the first time. And then you have continuing claims, individuals renewing their unemployment benefits. And so we actually saw a surprise reduction in unemployment claims. The market analysts were expecting 240,000 new unemployment claims week over week, and we actually got 222,000. And this was on the back of the previous week's reading of 228,000. So we've seen a dip over the last few weeks from the 250, 260,000 level that we have been at. So as always, this is something that we want to keep an eye on to determine whether this is a trend or if this is the anomaly. Continuing claims actually spiked. And this is part of why I think personally that the claims numbers for initial claims over the last couple of weeks declining may not be a big indicator of where we're going as an economy, because continuing claims were expected to come in at 1.435 million, and it spiked up to 1.73. So an additional 50,000 claims on the continuing level is what we saw. So as always, we just want to keep an eye on it to determine which direction that we're going and see the health of the labor market. Now, we also got the European Central Bank's rate decision last week, and they don't increase their rates lightly. Their rate, which is the equivalent of our Fed funds rate, which, when you hear the Fed increasing the rates or hiking rates, that's what I'm talking about, but on the European side. So the European Central Bank did increase its equivalent of the Fed funds rate 0.75%. So they're working over in Europe to help combat inflation as well. It's obviously a global dilemma or challenge that everyone is facing. So they've done that as well. Now today, we got some blockbuster numbers out of the US Labor and Statistics Board with CPI, which is Consumer Price Index. And this is an inflation report that comes out every month. And we get month over month inflation. We also get year over year inflation. And this came in a surprise to the upside, which is not what we want to see in the housing and mortgage markets. Month over month numbers were expected to come in at a negative 0.1% inflation, so deflation, and they actually came in at a positive 0.1%, bringing the year over year inflation numbers to 8.3% on an expected 8.1% reading. So this is a big deal. The markets did not like this news. We've seen the stock market take a pretty big tumble today. And we've also seen mortgage-backed securities or mortgage bonds, which drive interest rates. We've seen them take a tumble as well. And that's pushed mortgage rates higher. We're having a pretty rough day in the mortgage rate world today. Hopefully we can bounce back. But what this tells me is that the market does not believe that the Fed has a grip on inflation. We had seen the market rally, the stock market rally over the last week and leading up to today's report. And the report coming in higher than expected means that the Fed, which has been increasing the Fed funds rate, is not getting the job done, unfortunately. Now, what this also does is it also all but guarantees that we're going to see another 0.75% increase to the Fed funds rate at their meeting later this month. The Fed meets on the 20th and the 21st. Now, just as a reminder for those who are tuning in for the first time, the Fed funds rate is short-term lending rates. It is not long-term rates. So it does not have a direct impact on mortgage rates. It impacts directly things like auto loans, personal loans, credit cards, short-term lending products. So when the Fed increases the Fed funds rate, it's designed to combat inflation. And as inflation declines, mortgage rates would typically decline as well. So the Fed increasing the Fed funds rate is actually a good thing for mortgage rates. But since inflation is not playing ball, we're seeing mortgage rates tick up because inflation is staying high. I'll dive into a little bit more about inflation here in a moment. So we got that this morning. Looking ahead this week, also a relatively light week. We've got PPI tomorrow, which is producer price index, which is wholesale inflation. Now, wholesale inflation doesn't always equal the same numbers that we see on the consumer side. Companies do not have to pass the increase of their cost onto the consumers. They can reduce the amount of product being given at the same price. They can increase increase their or decrease their margins to offset. There's definitely several ways that that companies can choose not to pass those rising costs on to consumers, so they don't move necessarily congruently. So that comes out tomorrow. On Thursday, as always, we get jobless claims, so we'll keep an eye on that. And Friday, we're getting the University of Michigan Consumer Sentiment Report. And this is a survey of consumers on their outlook of the economy, how they feel the future of the economy is going to go. And so not something that we focus on all the time, but it is something that we want to pay attention to get the pulse on the state of the economy from the consumer level. All right, so diving in, what are we watching? What are we focused on? The big one is inflation. Today's CPI report really shed some light on how inflation is going to behave going forward for the short term. It does appear that higher inflation is here to stay for a little while. And unfortunately, that hurts us in the pocketbooks, that hurts us in the mortgage world, that hurts us in the real estate world, because that's going to continue to maintain higher interest rates on the short term, possibly drive them a little bit higher, depending on where we see additional inflation reports going forward month over month. On that note, we do get another inflation report on the 30th of this month, which is PCE, Personal Consumption Expenditure. Now, this is the Fed's favorite measure of inflation, and the most recent reading was in the sixes, the low to mid sixes, 6% range. The Fed's target is to bring that down to the 2% range. So we'll see where PCE comes out at the end of the month. However, we are getting the Fed meeting on September 20th and 21st. So they're not going to have the benefit of that September PCE reading before they make their decision. With the market being down, with interest rates being up, as I mentioned, the market appears to have lost confidence in the Fed's grip on inflation. And until we can start to see inflation under control, we're going to have a lot of volatility, both in the stock market, but also in the real estate, more specifically the mortgage market. And we could see higher inflation linger for a while, but the Fed is going to continue to try and combat inflation with their monetary policy, including Fed funds rate hikes. Now, let's talk housing and mortgage for just a moment. So what is the best way that you can fight inflation? And the answer is to purchase or buy fixed assets. Well, what's one of the biggest fixed assets you can buy? A house. So owning a home or buying a home is a phenomenal way to fight inflation, because unlike paying, say, rent, every year as inflation rises, landlords are needing to increase rents to keep up with inflation. So your monthly housing cost is going to rise on a year-over-year basis. Whereas once you buy a home, your principal and interest payment on that loan is going to stay the same for the life of the loan, assuming you're in a fixed rate mortgage product. And so you're combating inflation. Although the prices around you are rising, the cost for your housing is staying static. So that is an incredible way to fight inflation. So if you're a real estate agent watching, make sure you're having that conversation with your buyers and your sellers about putting them in a position to be able to combat inflation that appears to be here for a longer term. And then if you're a home buyer and you're not sure if buying right now is the way to go, if you're wanting to help put yourself in a position to prevent further increase to your housing costs down the road because you're renting, buying a home is an incredible way to do that. And with the market being a little bit softer right now, it's a great time for buyers to have an opportunity to get into a home without the crazy overbidding that we've seen over the last 6 to 9 months. Now, inflation remaining high will keep interest rates high. I've already mentioned that, and possibly drive them higher in the short term over the coming several months until we start to see inflation come down, and that's going to make home ownership less affordable going forward. In addition to that, home prices will continue to rise because we do have a low supply, medium to high demand environment. So low supply, high demand, prices rise. It's basic economics. So we are likely to continue to see home prices rise over the coming months and years, even if we end up in a recession. And that's because typically during a recession, home prices either plateau or they continue to rise. There's only been a couple of instances over the last 60 years where we've been in a recession and home prices have actually declined. It's not very common at all. Now, if you're a home buyer and you're saying, well, Sean, I'm seeing home price reductions all over the place or on a regular basis now. And so make sure that you're not confusing a home price reduction with a decline in home prices. A home price reduction most of the time means that they've simply priced the home a little bit too high to begin with. And that's pretty common coming out of a phase where home prices were rising dramatically, because you have a lot of sellers that say, hey, my neighbor just sold his home for X 3 months ago. I'm going to list my home here. Well, we're in a different real estate market than we were 90 days ago. So listing at this level, just because your neighbor sold at that level, may not be the right market price. And so if they listed it there, they're likely going to have to reduce that price, but it does not mean that their home price has come down. It simply means that they listed it at a higher price than the market is dictating in the current real estate market. The other aspect to keep in mind on that is understanding the difference between a declining home price environment and a deceleration in home price appreciation. Homes are continuing to appreciate, but the rate at which they appreciate will slow down over time. We are not able to maintain the insane double-digit percentages, 15, 20, 25% across the nation that we've seen. We are going to see that slow down a little bit. So that is a deceleration in home price appreciation. That does not mean that home prices are declining. They're simply going up slower than they have been recently. And so higher rates, higher home prices continue to deteriorate demand, which is going to create a more normalized supply and demand dynamic in the market. And that, if you're a buyer or if you're a real estate agent that works with buyers, is exactly what you want to see, because it's going to create a more balanced market where buyers have the ability to bid on homes and not be one of 40 offers. They're going to be able to get homes for closer to list price, whether just on the above side or just on the below side. And we're now starting to see the occasional seller paid closing cost in the right situation. Don't get it twisted. It's not on every home by any means, but we are starting to see them in certain circumstances. So it's becoming more of a normalized market, and buyers can take advantage of that. I encourage all of you buyers out there to think like an investor. Investors are buying homes left and right now because they know that the value is not in a lower interest rate. The value is in the equity that they're going to build in the home over time, and they'll have the ability to refinance to a lower rate to take advantage of that down the road. And so if you think like an investor, you're going to put yourself in a position to make a lot of equity in a home when you purchase. All right. Well, gang, that's all I have for you today. I appreciate you joining me for today's edition of SRT Live. Again, I'm your host, Sean Richard, loan originator with the Sean Richard Mortgage Team. If there's any questions you have, don't hesitate to reach out at the number listed below. You can also leave comments down below. And if you're watching this on YouTube, make sure that you hit that subscribe button so that way you get great information on the real estate and economic markets right to you on a regular basis. If there's anything else that my team and I can help with, I want to make sure that we're taking great care of you. Have an amazing rest of your week. Take care.